we have one of those who's about to speak now. And the attention to detail today is quite frightening, given the name of the next session is designed to tantalize all you investors out there. It's called Show Me the Money. And our next speaker, he has about $1 billion worth of exits and IPOs in his 20 years of experience. He also teaches budding VCs how to be VCs at Stanford. So please join me in welcoming Trevor Loy, the general partner of Flywheel Ventures. Thank you.
There ain't no more to it.
Great. Good morning, everyone. I am Trevor Loy. I appreciate the kind words of introduction, and I won't say a lot more about that. I will say two things. One is, for those of you who have seen me speak before, I do like to use a lot of data and graphs, so I'll be going through them fairly quickly. But before we get into all that, I guess what I'd like to do in the spirit of Thanksgiving is just take a moment and recognize how special and how much gratitude I have for being in this room with all of you at this moment in history. And obviously, those of us in the U.S. have witnessed a particularly shocking change in our orientation toward this part of the world and toward the last 70 years of the world order and how economic growth was thought about. I and many others continue to be the strongest possible proponent for that direction. We'll see how the next few years play out, but what I know is that it's not going to be governments in the long run that create the outcomes that we're seeking. It's going to be people in the room and the entrepreneurs, most importantly, the entrepreneurs who are going to change and disrupt things, using the resources we can bring. So I really do, especially on this Thanksgiving, appreciate the opportunity to be here with you today. So let's go ahead and jump in. As you mentioned, I kind of have three different kind of roles that are relevant to this. I am a venture capital investor. My firm is called Flywheel Ventures. I've been running that for about 16 years now. We have 4 funds. As you mentioned, we've created about $1 billion in exit value across IPOs and M&A events. I also teach at Stanford. I've been doing that for almost 20 years in a program that I helped build when I was still a graduate student called Stanford Technology Ventures Program, which is unique in that it teaches entrepreneurship inside the engineering school, not inside the business school. And I'm happy to tell you more about that because we're doing some work with the UAE right now to bring that kind of entrepreneurship education into the UAE. And I'll mention more about that in a minute. And then also, just as an aside, I had the honor a few years ago of spending 4 years as a director of the National Venture Capital Association, which is the trade group for the entire US VC industry. And in that context, I participated in testifying to the US Congress and the White House and various government agencies in helping to define and change many of the recent updates in the regulatory policy toward venture capital in ways we think are positive. So that's the context with which I'm here today. And the other context I would just say specifically is my VC firm, for the last, particularly the first 10 of the 15 years I've been running it, I've had a particular focus on investing in entrepreneurs outside of Silicon Valley, particularly in the Rocky Mountain West and the Southwest, which is the fastest growing region in the US for VC, and helping connect them to Silicon Valley. And I'll talk more about that later, but part of the context for me being here is I've thought a lot about what ecosystems that aren't Silicon Valley look like, and in fact, those are the ecosystems I enjoy investing in. This is a picture from earlier this year with a bunch of Stanford faculty at UAEU out in LA. Part of this program we're doing in conjunction with the UAE government, led by the ruler of Dubai. And it's a 3-year program in which we are developing curriculum that is going to be required for every graduate of every institution of higher learning in the UAE. We've already taught in the pilot over the last year, we've taught 5,000 students in 20 different programs. And our intention is to roll it out to all about 80 institutions over the next few years and have every student take this introductory curriculum. So it's been a real pleasure to be involved in that as well. I'm going to talk about 4 things today. Venture capital as an asset class, some of the drivers of how we got there in the US, how VC funds make money, and then a few thoughts on, as I said, my experience in working beyond Silicon Valley. The first three sections are going to be explicitly kind of very US-centric, and again, partly because I'm setting the foundation for what happened in the US, but if I could leave you with one sort of caveat, it's that I believe strongly that no entrepreneurial ecosystem has ever been built by replicating Silicon Valley. All the ones that are successful have built on what assets and what dynamics are at play in their own region, with inspiration from Silicon Valley, but not just trying to adopt it. If you just try to move it from one place to the other, you lose, as I like to say as a former engineer, you lose all the assumptions on which the equations were derived. So with that, three take-home points I hope you'll come away with today. The first is venture capital is a long-term, illiquid, and highly cyclical asset class. And I'd underscore what that means is the need for patience. This doesn't play out in a couple of years. This plays out over a generation or more. The second is venture capital investing is different from every other asset class in that the outcomes do not follow a bell curve distribution. They follow a power law distribution, and we'll talk quite a bit about that. And lastly, what those things mean is what it's really all about is having one or two startups in a fund that go on to be very, very successful, and they essentially pay for all of the other losses in the fund. And that's a different way of thinking about investing, because by definition, to be a good venture capitalist, 3/4 of everything you do will fail. And you have to be emotionally and psychologically sort of prepared for that failure rate. In fact, if you try to fail less than that, what you'll find is you stay away from taking the risk that leads to those big outlying successes. Okay, so VC is an asset class. This is the definition that we put together at the MBCA. It's an excerpt of a longer definition, but there's four kind of things I wanted to highlight. Venture capital firms are professional institutional managers of capital, which basically means other people's money. It means we have fiduciary duty, and it means we're trying to provide diversification to our investors. That enable and support the most innovative and promising companies. So obviously, innovation, which really translates into large and rapid potential for growth, particularly where it's disruptive, because that way you don't necessarily have to incrementally build value. You can transformatively and exponentially build it. The money funds new ideas that could not be financed with traditional financing. That's probably the most important thing in this definition, and it speaks to why we're here today, which is the other ways that you think about building economic growth in private companies don't work when you apply them to these disruptive, innovation-based startups. You need a different mechanism, and venture capital is that mechanism. And then lastly, it requires 5 to 8 years. That's for a particular investment. Funds overall take even longer. But the key there is it's long-term. As I said, it requires patience. The upside is this is really the last asset class in the world that can afford to ignore public market pressure around quarterly earnings, et cetera. We can take our startups and ignore their financial results for 7 years, and that could be exactly the right thing. So it gives us the opportunity to invest in the long-term potential of these companies. Now, why do we care? Well, we know that venture capital creates not only new companies, but entire new industries. The three most well-known ones in the US are healthcare, about 5,000 companies funded by VCs over the last 40 years. IT, about 17,000 new companies funded in the last 40 years. And clean technology and clean energy, which is about almost 1,000. But what's interesting is for all the attention we get, it's an incredibly small asset class. And this is news to a lot of people who think that VC is a bigger deal because it tends to get a lot more disproportionate media coverage and attention. This is from a couple years ago, and you can see, the size of the U.S. economy that year was 17 trillion, more or less. Mutual funds, about half that in terms of assets under management. Hedge funds, maybe 15% of GDP. Private equity, buyout and growth funds, about 10% of GDP, a little bit less. Venture capital, only 157 billion. So that's less than 0.2% of the total GDP in the U.S. So, of the people who are providing that capital that's less than 0.2%, there's a wide distribution of types of investors. The most common ones are pension funds, endowments, insurance companies, and foundations. And There's a lot of things we can talk about why those particular institutions have led the way. Probably the most important thing is something called the prudent man rule, or the prudent investor rule, which we'll talk about in a few slides in a little more detail. But again, for each of these individual investors, their portfolio looks something like this, where VC is almost a negligent sliver of the total assets under management. So again, why, if it's such a small asset class, why does it get all this attention? Well, first of all, it's been doing well. It's obviously cyclical, but since the Great Recession in 2008, you can see the compounded multiple return, is
Behind.
Hold it. Is that okay? Okay. So basically, it's been outpacing the S&P 500, particularly since 2007. So it's interesting that a lot of today's transformative companies driving those returns were actually founded during the 2008 2009 downturn, and that's not strange. If you go back and look at history, periods of economic decline are actually well associated with periods when the most transformative companies get started. And there are a lot of reasons for that, but the short one is everything's cheaper and there's less competition, and so it's actually easier to succeed if you're one of the strongest companies. Here's why policymakers in the US care. On that 0.2% of assets as a percentage of GDP, 21% of the entire private economy in the US is now comes from venture capital, companies that were backed with venture capital investment. Obviously, these are companies that are now publicly traded, so we all know Google and Apple, etc. But it's not just technology, it's also transformative business models and other categories of products. So Starbucks was venture backed. The Home Depot was venture backed. If you know the chain in the US called Jamba Juice, that was venture backed. So venture is actually a lot more broadly distributed than the technology sector. It's just that tech tends to get all the attention, and it certainly is the leading sector. Equally important, and again, this is why I'm so interested in this debate we're having around the world right now about how do you create jobs and economic growth. 11% of all the private employment in the U.S. has been created by companies that were backed by venture capital investors. That's an enormous impact on the U.S. And that's what gets policymakers' attention, obviously, around the world. So what are the drivers that led us to this point? There's basically four: public policy, education and research, capital formation, and what I would call business cultural norms. And I'm going to show you basically 4 slides, and I'll just have a bunch of bullet points. They're a little denser than I typically like. It's the one section I'm not going to have a lot of charts. But I'll try to click through these, and then in the Q&A, I'm happy to go into detail on any particular one that you'd like to know more about. From a public policy standpoint, having an efficient, consistent, and accessible legal system that entrepreneurs without a lot of money can interact with and get things done is key. Relaxing and optimizing bankruptcy laws so that you can do orderly liquidations and not punish people overly if the company doesn't work. And I know there's a new UAE proposed law that addresses that, so I think that's exciting. Intellectual property protection is an important area where I think my sense is that across the region, that public policy is probably still not yet developed to the extent that it could be. Technology commercialization and transfer and licensing. So how do you allow people inside of governments or universities or even other companies to take their ideas out and go do something and appropriately compensate where they're coming from, but not penalize them? Loosening of non-compete restrictions. Now this is uneven across different parts even of the US, but California, it's actually essentially illegal to have non-compete agreements, so you can't stop an employee to go into a competitor. And that turns out to be a huge driver of this entrepreneurial dynamism, because there's a free flow of people who are free to vote with their feet and go work for the most promising companies. Friendly tax treatment for stock options and other equity-based compensation for employees, so that the employees in these startups who are investing so much blood, sweat, and tears are rewarded in terms of ownership, not just in terms of salary. Incentives for government agencies to buy from startups. That's actually a really big one. There's a number of incentive programs in the US where the Department of Defense and the National Institute of Health and all sorts of government agencies at both federal, state, and local levels are incentivized to prefer startups if they can. And that allows the solutions not only to get adopted as a customer opportunity for the startups, but it makes sure that the government actually is getting more innovation more quickly into its own infrastructure. And then lastly is the core infrastructure investments that help speed and collaboration of humans to work together face to face. And that's the interstate highway system in the US, the modern air travel system, of which Dubai in particular is certainly a leader. Public transport, ride sharing, and then obviously internet and mobile capability, connectivity. In terms of education, one of the things that doesn't get talked a lot about that's essential is significant government incentives and funding to do basic R&D. And most people would think that as venture capitalists we care about applied R&D. Turns out that you can't predict in a linear way that if you invest X and Y in applied R&D, you'll get more companies. You actually get companies coming out of research that was being done in a very basic way without a market in mind or without an application in mind. That's where the really transformative ideas come out of. So as an industry, we've done a tremendous amount of work to support basic R&D funding and scientific communities. Access and exposure to entrepreneurship education, as I talked about earlier, both in formal curricula and institutions, but also increasingly in these informal programs that are run by accelerators and co-working spaces, et cetera. For university researchers, having really favorable leave policies so that they can go out, start a company, not lose tenure, and if it doesn't work, they can come back and get their job back. The outgoing president of Stanford University, John Hennessy, actually did that. He left the university to start a company called MIPS in the late 80s, early 90s, took it public after, I think, 5 or 6 years, and then came back, not only returned into his tenured professor job, but ascended to be the president of the entire university. And that sends a very powerful signal about it's okay for people in academia to go in and out of academic research and industry, and that fluidity is actually a really powerful thing. And then lastly, incentives for hiring trailing spouses. So one of the issues, particularly when you're building markets, across borders, is the one entrepreneur, wants to move to Dubai or whatever, but he or she can't find a job for their spouse, and so they don't move. And so if you can figure out ways to make what we call the trailing spouse have flexibility in finding employment in the new location, that does a lot to speed up the rate at which entrepreneurs will move around to the most favorable markets. Capital formation policies. So by far and away, the biggest one was 1978 government decision called the Prudent Investor Rule, which basically said that institutional investors, it is consistent with their fiduciary duty to invest a small and prudent percentage of their capital in highly risky, highly illiquid asset classes. Prior to that, there had been thinking that it was not consistent with fiduciary duty to do that. And so institutional investors were very wary of being able to deploy capital for fear of the legal ramifications. Favorable capital markets for IPO liquidity, things like the NASDAQ and increasingly some of these other platforms. Liability protection for the limited partner investors so that people providing the capital know that they're safe from whatever happens with the portfolio. Here in the UAE where there's, you have this incredibly favorable tax situation, this may not be such a big deal, but in traditionally high tax countries, lowering the capital gains rate, particularly the long-term capital gains rate, does a lot to move capital toward this. And as you know, in the US, we actually distinguish between short-term and long-term, and the VC industry actually lobbies hard for the short-term capital gains rate to be higher and the long-term capital gains rate to be lower. So that distinction is important as much as the actual tax rate. Tax incentives for angel investors, so individuals who want to put money to work. And then there's a whole program called Qualified Small Businesses that allow investors, if they take the profit from one investment and invest it in a certain period of time in another startup, they don't pay any tax on the profit from the first one, which is an incentive for people to just keep rolling their capital from one startup into the next one. And that does a lot to keep money in the asset class. And then lastly, cultural value stuff. Again, the customer willingness to buy from startups, and the ability to have face-to-face investing in meetings like Donnie talked about with the growth of the industry here. Probably the number one biggest thing, and this is true everywhere in the world, it's also true in most of the US, that there is not a strong cultural acceptance of failure. And the social stigma from trying something and seeing what happens if it doesn't work keeps a lot of people from doing it. The beauty of Silicon Valley and the other regions around the world that have followed in its wake is the degree to which we not only tolerate failure, but we celebrate it. If an entrepreneur fails, as long as it's for the right reasons and not ethical problems, we see that as tremendous experience, and they are now more likely to be experienced and capable to do the next startup. So having a failed startup on your resume makes you, in a lot of ways, more attractive to investors in the US. Another one is the integration of immigrants and native citizens into the ecosystem. I have another whole set of data on this topic, and obviously it's something that's particularly poignant today in the US. Over the last 40 years, 51% of startups in the US, so those 17,000 and 5,000 that we talked about, 51% were started either by immigrants to the US or the first generation of their children. So there's this tremendous driver of people moving across borders who create startups and finding a way that integrates them into the social fabric of that economy and that ecosystem is essential. Keeping connections to Silicon Valley and other tech centers is really important. And then lastly is something we call the give before you get mentality. The academic terms for this are kind of abundance mentality versus scarcity mentality. It's basically the idea that the culture evolves in a way that entrepreneurs and investors and service providers do favors for other people without expectation that there will be any reciprocity in any known way. And they trust that in doing that, the system itself will sort of, almost in a karmic kind of way, sort of, reward them down the road for having contributed to that. And that's probably the biggest distinction I see in different markets in the US, is the degree to which those geographic communities do or don't kind of operate by that code. Okay, so how do VC funds make money? Obviously, we've got entrepreneurial talent that works off market opportunities, takes scientific research and innovation, gets patient risk capital from folks like us. They turn it into products that then fit a particular market, and then they use that product market fit to drive a sustainable business model that proves that there's a real business. And then they tend to get liquidity, again, through IPOs or M&A. And obviously that liquidity flows back into the pool of capital that's available for the next startup. One of the things that's really important in the growth of regions, and where, as Danny talked about, I think it's still very, very early here, is that flow of liquidity not only benefits the LPs who put the money in the first time, but those LPs tend to make commitments over and over to the successful funds. So if this fund is successful, 30 million, they're probably going to be able to raise like $80 million fund a few years later. And if that's successful, they'll be able to raise a $200 million fund. And all the time, it's the same limited partner base that's flowing capital and recycling it back through the system. And that long-term commitment over a decade or two is really important. And one of the things we've benefited from in the US. There's a long process by which VCs go through screening which investments to do. I'm not going to take you through all the details, and somehow the formatting got a little screwed up anyway. The bottom line is, once you're actually looking at startups, typically it takes 3 to 6 months before a VC, from the first meeting with the VC to when the money is actually wired as the investment. More interestingly, that almost never happens. So in the US, the statistics are basically that about 1% of all the startups get funding. And that's certainly true in my own firm's statistics. So out of 100 startups that you look at, about 10 of them might look interesting, and you might put really a lot of due diligence into 10 of them over this 3 to 6 month period, but you're only going to actually invest in one of them. And so the understanding of how to pull the right opportunities is really important. Because the set of these that you choose, every single one of them that you choose has to have the ability to be that one outlier that drives the returns for the whole fund. And again, I'll come back to that in a little bit more. There's two primary forms by which in the US VCs make investments. Preferred stock or preferred equity is the most common one, and at earlier stages, also something called convertible debt, which is really not so much debt as a kind of holding place until you figure out more about what the startup's really worth, and then you convert it into preferred stock. And there are lots of mechanisms for that. I'm not going to go into the detail. But the key is that each of those structures is negotiated with the startup using something called a term sheet. And the term sheet has 4 basic components. The capitalization and valuation, so who will own the business and what will it be worth, both before and after the investment. Who gets to control and influence and govern the startup. What are other economic terms that might change the payout at a liquidity event so that it's not just based on the percentage of ownership, but it's based on other kinds of factors. That's actually very, very common. And then a whole bunch of other things having to do with sort of legal matters and whatnot. So the key is that the percentage of ownership that you buy as an investor and the capitalization, which is who owns what shares, are actually highly disconnected in venture capital investing from the actual payout economics and from the actual terms of who controls. And this is probably the most common misconception of inexperienced entrepreneurs, etc. So it's just something I wanted to focus on. All of that term sheet gets turned into a whole bunch of 100-page long legal documents, of which there are examples at the US MVCA website. And then after that, the real work begins. And most of what you do as a venture capitalist after you make the investment is you spend the next 5 to 8 years working closely with the startup to help them grow and to monitor and govern how they grow. And this is not intended to be decipherable, but this is an actual slide from the board deck of one of my companies from a couple of years ago. And it just gives you a sense of, we're looking at all of these data and metrics of these companies constantly. Oh, okay, sure. And one of the reasons it's important to think about that, and for venture capitalists to really have experience and capability in helping the startups achieve those metrics, is the length of time it's going to take. It's been increasing. Back in the 90s, it was about 3 years in the dot-com bubble from the first investment to where you would typically get liquidity. That has increased now to basically an average of between 7 and 8 years. And I sometimes point out as a half joke, in the United States, currently the average is up to 8.5 years from seed investment to when you get an exit. So as a VC, you're going to work on average with the entrepreneurs for 8.5 years. And the average length of a marriage in the US right now is 7.2 years. So I'll let you interpret however what that means to you. And now we get to, again, a little more emphasis on this power law distribution. And this is probably the single most important thing I'd like you to take away from today. 65%, this was a distribution of exits of VC-backed companies in 2013, just as an example. And on the horizontal axis, it's basically companies that lose money, companies that make between 1 and 5 times money, 5 to 10 times their money, etc. And what you see is that 2/3 of the startups that we invest in lose money, right? And by the way, a big chunk of those are actually lose all of them. So it's almost misleading to put 0 to 1. It's really like 0 to 0.1, and then everything else. So and then obviously you get about a quarter. You get 1 to 5 times your money, and depending on how long that takes, that's okay. But if you make 2 times your money over 8.5 years, that's actually not all that great of an IRR, certainly for the risk and liquidity you're taking. So the real key to success is these long tail outliers here. And I just want to, for those of you who maybe a little rusty like me on your statistics, right? Most portfolio theory is based on the normal distribution, also known as a bell curve, in which you get a range of outcomes around a middle that then have tails on both sides. And most of the ways we think about investing and building risk and diversification are built on those assumptions. Those assumptions are completely wrong for venture investing because, as I've shown, it's a power law distribution, not a normal distribution. And so you have to really rethink what it even means to build a portfolio in venture capital. And the basic way is you don't de-risk it by just doing a broad swath of investments and kind of passively monitor them. You make a small, relatively small, let's say 20 to 30 on average, investments in a fund. You're very thoughtful about which those should be. And then for the next 5 to 10 years, you work as hard as you can to help get the outcome, knowing that only 1 or 2 of them are essentially going to define the outcome of the whole thing. So if I just kind of re-emphasize that, I really do think the power law distribution is the single most important sort of mindset. You have to kind of unlearn normal distribution because we've all taught to think about the world in bell curves. And if you unlearn that and then start from power law assumptions, all kinds of things about venture capital investing suddenly make a lot more sense. This is actually interesting data just to show you, it's not just 1 year at a time. This is data over 40 years from the most active investor in the US in venture capital over that period, which is Adam Street in Chicago. And you see here, essentially the money invested in those startups over 40 years is the blue bar. So it's, basically what we showed earlier. These two are both losing if you add them together. But almost, the value is the red bar, and so the total value created from those investments is almost entirely companies that did better than 5x. But they're a very small amount of the total capital that is deployed. So again, from a power law perspective, if you're going to invest in venture capital, you're going to prepare to lose most of your investments and lose most of the money you invested, knowing and hoping that you'll make it up tremendously so by the outsized exponential gains you get from the small number of outliers. Okay, lastly, beyond Silicon Valley, just a few sort of quick thoughts. In general, around the world, I think this is US data, it's probably consistent everywhere else. Most investors who have already made the decision to invest in venture capital tend to just repeatedly invest that capital back into the same fund. And so one of the issues historically, particularly with the dominance of Silicon Valley, is you have this persistence of 20 or 30 brand name firms that tend to dominate the news and the deal flow and the LP commitments in the region. The green bars here is basically the percentage in each year of capital that went to new funds, new fund managers. But having said that, when you look at it by region, North American LPs are dramatically more likely to put money into a first-time venture capital fund than any other region. And this, in my opinion, is an underestimated important driver of not only the growth of the VC industry in the US as a whole, but in particular, the growing geographic distribution of that investment capital across the US. Silicon Valley still dominates, along with Boston and New York and Southern California, but the numbers in some of these internal regions are non-trivial. And that's because historically LPs in the North American market are more likely to support first-time funds getting created in these other regions, and that has led to a lot of outsized success because there's a lot of inefficiency in doing venture capital in those markets. And obviously, I put my money where my mouth because for the last 15 years, that has been explicitly my investment strategy, which is to arbitrage the inefficiency of these other regional markets where there's tremendous talent, university research, lower cost of doing business, but then use my connections and my history in Silicon Valley to connect those entrepreneurs to capital and talent and knowledge in Silicon Valley, and building those bridges, and that's essentially how we make money from arbitraging that inefficiency. Around the world, the good news is the global VC landscape is growing. It's becoming more diverse as well. Obviously still dominated by the Northeast and the West Coast of the US, and growing particularly in Europe and Asia and India. But there are some interesting places, starting to see Santiago, Chile, Sao Paulo and Rio in Brazil. Obviously some other places, some of the second and third tier cities in China are growing very quickly. We don't yet see a meaningful dot, here, but I'm hoping the next time they do this chart, it will. And one of the reasons I'm quite confident that you guys are going to start to show up on this list is this quote from Fred Wilson, who's one of the most successful VCs in the US. He backed Twitter and a number of others. And I apologize from the text. He's commenting on the researcher named Richard Florida who put together the data in this map. And I'll just read the highlighted part. Investors value their time and focus it on markets that they can get in and out of easily. And I think that has a big impact on where money flows. And that's becoming increasingly true. So the importance of nonstop connections, air connections in a global sense to other global cities, I think is not nearly appreciated as much as it needs to be for a foundational driver of building a successful VC ecosystem. We also are starting to see the MENA region show up. This data is a little older than my other chart. So at the time of this data, about 80% of the VC in the world was US, and then spread out in the others. But MENA, is into the 1% range, which is non-trivial because we're talking about a lot of money. And I'm sure that's going to continue to grow. And then lastly, I'll take a moment to just end on this slide and then we can do some questions. But I'm no expert on this region. As part of this Stanford program to work with the UAE government to build curriculum, I've now been to Dubai for 4 times in the last 12 months, for about a week at a time. And thanks to my friends at GIC in Kuwait, I got to make a visit to Kuwait earlier this year. So I'm spending a lot of time over here, and given the jet lag from the west coast of the US, that's a non-trivial investment of my life energy to do that. And I'm doing it, for a couple of reasons. One is I do see financial opportunity in the longer run, and that's starting to be more of my focus. I'm growing more and more interested in regions outside of Silicon Valley, outside the US, and not just inside the US, other regions. And the other is, there couldn't be anything more important in the world right now than to drive the success of entrepreneurial ecosystems and job creation in all kinds of the world where they haven't been participating. So that's why I do it. So I say that because I don't want to say that I have expertise on the MENA region, because I don't. But it's sometimes useful, I think, to have an outsider just sort of first glance, again, based on 4 or 5 trips and conversations. And here's some thoughts I kind of came up with on advantages and challenges as I see it. The first advantage is down here, already talked about, is there's kind of a cohesive population that shares language and cultural characteristics. That's reasonably sizable, and the figures get debated. That's a non-trivial reason why Europe has really struggled. Venture ecosystem is much truncated in more than it should be, because it's not easy to be a startup in France and just go to Germany and then go to Austria and then go to Italy. Essentially, you have to create a new startup every time. Certainly, legally, to do that across the MENA region, you need to do it in terms of cross-border, structures. But culturally and linguistically, if you're in one market, you can transfer a lot of that knowledge to the next market. You don't have to start over. That's a huge advantage of the U.S. because, regardless of where you start in the U.S., you have access to the entire cohesive set of laws and population and customers. There's a very long-term cultural and economic history of exploration and trading, and just a comfort with risk-taking historically, for the last few thousand years, that isn't true in a lot of other places. I've been spending a lot of time recently in Chile as well. And one of the things they struggle with is they don't have thousands of years of a culture that's oriented around exploring the world and trading and interacting. So they're much more insular, and that's a real challenge to get their entrepreneurs to think more globally. The youthful demographics that are being led by these digital native, the millennials and even the generation below them who are growing up with these smartphones like surgically attached to them, I just think it's a huge advantage versus other places that have older, aging demographics. We talked about smartphone and internet connectivity. We talked about air transportation. I mentioned the importance of immigration-friendly hiring laws, and it's not just hiring them, but it's integrating them truly into the management and the power and societal structure of the ecosystem so that they feel equally valued as the native citizens. A huge advantage in this region is, as many of you know, is the presence of sovereign wealth funds, not only with tremendous capital, that's true in other parts of the world too, although certainly here it tends to be even larger. But the sovereign wealth funds here have decades of experience deploying that capital against long-term priorities that are important for the culture and the economy and policy. That is not true of sovereign wealth funds in most other parts of the world, especially interestingly in the US. The sort of state government funds are often very reticent to invest in anything that's more than a year or two because of the political ramifications or whatnot. So the fact that you not only have the capital, but that the capital, like you know how to do this. You've been doing it with hydrocarbons, you've been doing it with real estate, you've been doing it with transportation infrastructure. This is just the next thing that you deploy that capital to drive a priority for the region. And then lastly is, there's also, what I can tell, a growing consensus in the region about the need to transition away from hydrocarbon and infrastructure-based, as the drivers. Certainly those are going to continue to be important. And that consensus also doesn't exist in a lot of other places. So one challenge in the part of the US where I invest, which is also tends to be more resource-based in the economy, is there's very much not a consensus that that economy should try to transition to a knowledge-based one. There's a lot of political opposition to that. And it really prevents the kind of cohesive policy making that I think in this region you're in a position to do more rapidly. Okay, so then with that, challenges, that same focus in the last few years obviously has created industries and companies and individual people, managers of companies who have experience more in these other sectors, hydrocarbons and infrastructure and real estate. And that leads to a limited pool of talented startup managers who have done it before in the region, right? And so you're still in a position where for a startup to grow here, you either need to sort of scale it somewhere else where the talent is, or you need to move the talent here. And that can be done, but it's just a slower process. There's obviously geopolitical stability and conflict in the greater region. Have much more to say other than, I think certainly we all know, it's real, but I also think, and this is particularly a problem, on my side of the world, it's a lot more imagined, and unfortunately the perception often drives the reality. So it creates a branding problem, honestly, that, I think a lot more VC investors and entrepreneurs don't consider coming to this part of the world because of concerns about this that are actually not well grounded in the reality. And that leads to a peripheral awareness of the region in these other tech-centric places. There is still in the region this cultural stigma I detect around failure. And then lastly, there is still a challenge. This region's done an incredible job of building societies that are heavily populated by immigrant workers, but I don't think yet culturally they've been integrated as equals into the economic ecosystems and into the societal power structures. And in the US, particularly in Silicon Valley and these other places, that is what happens, and I don't think they'll get the big impacts until that happens, and that takes time. And it takes these kinds of meetings and these kinds of people. So with that, I'm going to wrap up. I don't know how much time I have for questions, but hopefully maybe a couple. 5 minutes. And here's all my contact information. Okay, great. So if you want to stand up and ask for the microphone, there's some ladies bringing them around in the back. We have one up here.
Vicky, I just had one quick question. If you had to choose between a great team and a pretty decent idea versus a mind-blowing idea which you, as top-level analyzer of ideas, and not know what the potential of the team was, so which one would you go as an investor?
It's not even close to the team. Great teams will figure out whether the great ideas are really great, and if they're not, because most of the time great ideas turn out not to be great for reasons you can't anticipate. Great teams will figure that out faster than the competition, and they'll move on and iterate to the actual idea that is the great one. And if you stay with the great idea, particularly if you have a mediocre team, you're just locking yourself into a strategy that's completely dependent on that one idea at the beginning being right. And the odds that that's going to continue to be true, that thesis, for 8.5 years is just almost never true. So if you look at all these big successes, almost all of them started out doing something quite different than the business and product and technology and idea that they eventually went to success with. And that's why you need great people. Yep. Here.
Hello. Hey.
Oh, hey.
Sorry. You talked a lot about creating innovation in different ecosystems outside Silicon Valley. But can you talk a bit about exporting innovation from those locations to the rest of the world? So if you take MENA, for example, exporting innovation from MENA to the Western world.
Yeah, so I have a fair amount of experience with that. A large number of my personal investments are, the original founding team is in some world-class university that's located in a town or a city that's not a major population center. And so we've gained a lot of experience, and the way we tend to approach it, we've found generally works best, is that you keep the original product and innovation team in that original location. It's just really hard to move and replicate the intensity of their passion of those original, usually engineers and product designers. But then you have to be very willing and put a lot of thought and attention and investment into building sales and marketing and branding and business development offices in other locations, while making sure that your other locations are maintaining cultural connectivity and communication back to the home innovation office. And the last part is the hardest part, but it's gotten a lot easier than when I started 15 years ago to do that with all these collaborative tools. So that's the way I tend to view it, rather than thinking you're going to pick up the entire thing and move the whole. Up here? Up here? He's got the microphone, so I'll go to him, and then can you bring the microphone to her? Yeah.
Hi, my name is Khalid, and I'm from the United States, and I've had the opportunity of being a successful consulting firm. I've been on the other end of the spectrum, but I've done my business the old-fashioned way, like importing and buying from many VCs. And this is my first foray to try to do venture capital investing. I've, being on the other side of the fence, having built a business, I've looked at it from a very skeptical perspective. I've called,
as you should.
do I call them venture capitalists or do I call them vulture capitalists? That does be my perspective. Sorry for the pun, but
I took my horns off.
Okay. So I've spoken to many colleagues of mine, like many other CEOs, who say, you've got to stay away from VCs if you can, because they'll stifle your business. Many of them don't quite understand, your business, and they're just looking for a quick buck, as soon as possible.
Yep.
I do understand that mentality, if you invest, you're out there to make money, I quite get that. So here I'm on the other end of the spectrum, trying to invest in venture capital funds and so forth. So my question is, in your many years as a VC, when you approach entrepreneurs, you invest in their companies, do you sense that the CEOs or the founders of the company are being, stifled if they don't produce growth, every 6 months, every year, and so forth, and really feel pressured, by the VCs, and just wanted to get all the thoughts.
Yep, I get this question all the time. So, and I actually have, I think, a pretty short and concise answer. Winston Churchill famously said that democracy is the worst form of government except all the other ones. And I would say venture capital is the worst form of financing for a startup except all the other ones. What I mean by that is venture capital, we only fund 1% of the businesses, and that's not just because the other 99% aren't good. It's that they don't fit a very specific set of criteria around that power law distribution, which is to say, the startups that make sense to take money from VCs are not the kind of startups, like it sounds like the one you built, that have sort of methodical, steady, linear, or even, slightly exponential growth. The business model of venture capital will stifle and actually end up probably treating the owners of those businesses punitively, which is why it's important to stay away from them, because they also won't generate the outsized returns you need. The businesses that fit venture capital are those that have the potential to deliver 10, 20, 50, 100 times the original investment in 5 to 8 years, right? The things that explode, the kinds of businesses that, my top company had to hire 300 employees in 3 months, right? So that kind of explosive growth, I think the opposite is true, which is if that's what you have to do, if you don't get both the capital and the access to the connections and experience from a good, high quality, reputable VC, you will almost certainly stifle that company from ever achieving the escape velocity, because you can't just sort of bootstrap those kinds of companies. And I think there's been too much, in the way the media talks about this, the media sort of talks about VC as a solution broadly for all entrepreneurs, and I think it's a terrible option for 99.9% of entrepreneurs. It's only this very special category of explosive potential companies for which it really makes sense. And the entrepreneurs then culturally need to know that they're getting into that, they need to buy into that, that they're trading the opportunity to have a nice, solid, modest success that's meaningful to their family, but not to the investors. They're giving away that option explicitly to bet it all, put all the chips in and bet it all on the home run. The example I think of right now is Snapchat, which famously 2 years ago turned down an acquisition offer of $3 billion. Now they're going to go public at $25 to $30 billion, right? I know those guys. They're a little younger than me, but they went to Stanford. And the reason they turned down the $3 billion is they don't care about making, you know, $5 or even $15 million for themselves. They wanted to be billionaires, and they want to change the world on a global scale. And so they were willing to turn down the more reasonable path in order to bet on this really much more risky but potentially explosive path. So hopefully that's helpful. Thank you.
Thank you, Professor Trevor, for this very insightful presentation. I'm Helen Turki. I'm founder of Common Education, which is an online Arabic platform that delivers online education in the digital field to grow digital entrepreneurs to a global standard. Almost something similar, you can say, to the Audacity, but for the Arab world.
Great.
Yourself being of education and venture capitalist background, I'm keen to hear your perspective and insights into venture capitalist investment into the online education field.
So I have one investment in that space that is a company that delivers monthly subscription-based kits to kids that teach kids how to write code using Play. But I'm no expert in it. So if you don't mind, I'm not going to make a comment specifically about education. I will make a comment though about sort of the way you framed it, which is your sort of Udacity for the Arab world. Sometimes that works, and I know there's going to be a lot of conversation today about when does that work. So you know, Kareem has done a great job of being the Uber of here and holding off Uber. The danger, however, and something I think entrepreneurs in regional markets don't think enough about, is one of my friends said, you know, the eBay of Kazakhstan is called eBay, right? So with the global scale of connectivity, you have to be careful that a lot of these platforms are actually going to beat the local players because they have more scale. And so understanding when and when not that's likely to play out, which is beyond the scope of what I can answer today, is really the fundamental question in thinking about these investments. So I know I'm out of time. Unless any burning questions we want to get? I don't see any. Okay, great. Thank you so much. It's an honor, and let's keep making the world better.